All right, Scarlett Phil and Paul Sweeney. We are broadcasting live from the New Jersey Institute of Technology in Newark, New Jersey. A lot of geopolitics on the front burner, of course, but it is still earnings season. Right now, we got the big banks kicking off earnings today. Goldman Sachs put out some numbers here. I thought the numbers, I'm an equities guy, so I looked at their equity line first, and they just crushed it. A little bit light relative to expectations on the fixed side, the fixed income side, but those are bond people. Who really cares? But anyway, it's a big business. It's a big business. But let's check in with Neil Sipes. He covers his stuff for Bloomberg Intelligence. Talk to us about Goldman Sachs and the quarter they just released.
Yeah, so I think the general broad strokes is that the core capital markets business is firing, right? As we sort of entered this quarter's results, we obviously saw markets in flux, right? And obviously plenty of uncertainty down the pike here. But ultimately, a lot of volatility in the quarter, particularly in equities and fixed income products, mostly geared towards the later quarter. And so there was sort of a high bar coming into these results in expectations for a trading-led sort of beat. And frankly, we saw that really come through in the equities business, now on fixed income. That's where the bigger miss has sort of overshadowed strength in other categories for Goldman. And so, a lot of that relates to specific products. Obviously, when you have volatility, it's not always perfectly positive volatility for the trading business. So a little bit of mix within that. And then when you look at the investment banking business, M&A, ECM, debt fees, all of those beat expectations. That was a big story heading into 2026, was the expectation for capital markets, for debt issuance, equity issuance, particularly IPOs and M&A to come back firing. The first quarter was solid. The backlog has dipped a little bit from a 4-year high in the prior quarter, so coming off a little bit. Part of that is due to when you have such strong results, things come out of the backlog. But I think the bigger question as we move forward is, with the elevated volatility that's positive to trading, that tends to be not so helpful for the investment banking side. So how are clients transacting early in the second quarter is a key question, and Goldman says they remain engaged.
So when it comes to that surprise drop in fixed income trading, do we think that that's Goldman specific, or is that something that could have a read-through to the other big banks?
Yeah, I think that's what we're sort of going to be looking very closely at. It feels that it could be a little bit unique to Goldman. Again, it depends on the actual positioning within this business. When you look at some of the other large peers in the space, JP Morgan, Bank of America, Citigroup, they all sort of guided to mid-teens growth across the trading business for the first quarter. And that guidance came in early mid-March. So the expectation is, this could be a Goldman unique scenario where fixed income trading revenue was particularly weak. But we'll have to watch, right? Again, volatility tends to be positive for the trading business, but it's not a perfect relationship. And so we'll have to be watching, particularly given the sort of high bar and the expectations coming in that trading was going to be so strong.
Hey, Neil, I'm thinking about 2026 could be just a monster year for IPOs here. I'm thinking SpaceX, maybe some of these AI names like Anthropic. What are some of the big investment banks saying about that opportunity?
Yeah, and I think that is a big opportunity in the offing, right? I think a lot of it now relates to, okay, these IPOs are coming. At what pace will they come, right? And so are these 2026 stories? Are they first half, second half, or do things get kicked into 2027 if the uncertainty that we're living through today prolongs and it sort of causes sponsors and strategics to sort of put pencils down and sort of reassess that opportunity. Goldman noted IPOs a little bit softer in March. I don't think that surprises anyone, right? Just given the volatility. I think they remain bullish moving forward on that business. So I think it's just going to be a timing question of rather when, not necessarily if. But of course, plenty of uncertainty is still out there. So that remains the big question.
Has David Solomon, the CEO, said anything about the geopolitical uncertainty, the war in Iran, and what that means for business prospects overall?
Yeah, I think he has hinted at that same sentiment, right, where the volatility keeps clients engaged. So it's again positive to the trading as you think about how you have to have institutional clients have to reposition or allocate for a much wider range of outcomes and scenarios when we're sort of going through what we've had with AI scare trades, software concerns, now war. That all sort of creates a pretty good backdrop for the intermediation type business when we have markets that, frankly, are still only a handful of percent off of all-time highs. That's really strong for the financing business that Goldman's been growing in. That was a really bright spot for the equities business in the first quarter. They're continuing to deploy balance sheet into that business, so they see an opportunity to sort of lean into client needs and client demands in this environment, albeit cautioning that there's a big uncertainty piece out there.
Neil, thanks so much. Really appreciate it. Neil Sykes, he covers all the big banks for and investment banks for Bloomberg Intelligence. We appreciate getting some of his time there again.